Okay, before we start, somebody filled out a quiz last week and didn't write their names on it. So if you got like a 0 and you think you should get some points, just make sure this isn't you. So I'll leave this here in case one of you wondering why you didn't get enough scores, get any points. So I'm going to go over the quiz first. So then you know whether or not you should have got points, but you didn't. I should have released the grades. So for those of you who haven't noticed, the grades have been uploaded. So let me double check that. I don't want to show people's names. Yes, I believe the grades are released. So you should be able to see your quiz grades. If in case that you think you are entitled to more points than what's given to you, talk to me and I'll dig up your scores. So I'm keeping your physical copies, but you get to see your points. Okay. So for last week, just remember if you see a 0, but you were in class and you think you got more than 0 points, then that might be yours. I'm willing to give those points to you. Otherwise, you get a 0. Okay. All right. So let me go over the quiz first, followed by the problem set number 3. So you should have noticed that problem set number 3 involves some amount of digging through actual IMF data and also testing or empirically verifying whether or not CIP or UIP holds in reality. And just plot the time series of how frequent CIP, UIP is violated, and it should be quite obvious. Just looking at the error, right? The error. Okay, so that's problem set 3, and then I will review a little bit about calculus just to understand, because I have to introduce to you some functional forms. I'm not gonna impose too much structure, but I'm just gonna assume that these functions you can take up to first derivative, maybe even second derivative. So that requires some continuity or well-defined properties of the function, so you can take derivatives on it. But in any case, I'll review a little bit. You don't need to know too much. Just know that when I take the first derivative, I'm looking at the sensitivity of the functional form with respect to changes in certain parameters. That's what we're trying to do. And because it's more than one variable, it's multidimensional, and it's probably easier to visualize that in 3-dimensional. So I'm going to show you a 3D picture of what a multi-variable function looks like, and then see how taking derivative changes things, or what that implies for what the graph looks like. Okay, followed by today's topic, which is on monetary policy effects of exchange rates. So today's agenda is to extend the UIP model to incorporate the money market, which is based on, as you could imagine, money demand and money supply. Money supply comes from the institutions that create money, which is the central banks of every country. In Hong Kong, it's the Bank of China, Standard Chartered, HSBC, these consortium of banks that prints money on behalf of HKMA. In the US, it's the US Federal Reserve. In China, it's the PBOC. Okay, so these institutions create money. That's where the money comes from. And to find an equilibrium in an economy, supply must equal demand. So where does demand come from? We need to model that. And the inputs to model demand comes from, as you probably should know interest rates, right? The opportunity cost of holding onto money. Opportunity cost refers to the next best alternative to holding onto cash. So there are many, many reasons why you might hold on to cash, right? You hold on to cash because you want to buy something today, or you think you want to buy into a specific asset to earn a return. Many, many reasons. That's called precautionary savings, right? Or precautionary investments. You hold on to cash and you want to invest maybe very soon. And the reason why you're willing to do that is because the next best alternative is not so great, right? For a long period of time, from maybe the year 2008 onward, all the way to the pandemic, right? Interest rates were 0%. There's really no reason for you to hold into cash because you literally earn 0% on holding onto cash. So people made a lot of speculative bets, whether it's real estate or tech stocks or whatever. That's fine. That's what people do, and people respond to incentives. And that's what we're going to try to model. We're going to try to model our demand for cash through the opportunity cost of cash, which is interest rates, and also also real income or national income. So you remember Y, right? We learned from Y in the first 2 weeks. That's going to be part of our functional form function of money demand. All right, so that's where we're headed. We need to model money demand. We need to model money supply. And we're going to try to combine that model with UIP so that you can now know where interest rates are determined. And as a result, given you know how interest rates are determined, you know how exchange rates are determined, right? So there's a sequence of logic now. Okay, so that's where we're headed. And then our final takeaway, of course, is I want to explain to you using the model we have at hand to show you that given the simple assumptions we made so far in this class, like it's a very simple model, it's just a linear model for exchange rates of interest rates, right? And then plus another more or less another simple model to model interest rates. We can actually generate some features of empirical data. Namely, if you look at the data for exchange rates, it's very, very volatile in several years. And it's hard to explain why there's so much volatility. But given our model, you'll see that just given simple assumptions, very tractable model, along with some comparative, holding some variables constant, you can get this overreaction sometimes in the FX markets. And it's all due. The takeaway is it's all due to prices. Okay, it's all due to price levels not moving as quickly as market prices do. Okay, so let's get started. So question 1 of our last week's quiz reads the following. So I think this is just a review of the understanding of CIP, how to solve these CIP questions. So the takeaway again, the best way to approach this is to first determine again, which country is the foreign country, which country is the domestic country. Once you establish that, you can assign R and R star, and the rest is just plugging and chugging into the equation, right? So the spot rate for Chinese yuan per Canadian dollars. So here, the denominator is Canadian dollars. In terms of Chinese yuan, 6.444. If the Canadian interest rate is 2.5% per annum, and the Chinese interest rate is 3% per annum, the 3-month no arbitrage forward rate is closest to which of the following. So it's not specified here, but these interest rates are APRs, okay? So that means simply just dividing by, in this case, 4 should give you the periodic rate. Okay, so I didn't say that, but you should still get something close to that if you assume some sort of compounding, which is okay. All right, so 2.5% refers to the domestic, right, which is Chinese yuan, and 3% refers to the 2.5% refers to the Canadian, so that's foreign, and 3% is the domestic, right? So R is foreign, so foreign is 2.5% divided by 4 gives us 3 months, and 3% is domestic for China, and divided by 4 gives us 3 months. And so because our forward contract is at 3 months horizon, therefore we have to match the investment horizon as well, right? So given these periodic rates, matching with the forward rate horizon. E is our spot rate. Solve for F. Should get some number like this, right? So it should be C. Okay. Super simple. So I won't spend too much time on that. So let's move on. Quiz question 2. If no arbitrage forward exchange rate for euro in Japanese yen. So the way to read this, right, is the price of euro. So the foreign currency, right, is euro. So maybe I just put asterisk. So it's euro is the foreign currency. Japanese yen is the domestic currency, right? Because we're asking for the price of a euro in terms of Japanese yen is less than the spot rate. So we're saying F is less than E, and we know that JPY, I wrote it here, okay. JPY is domestic, foreign is euro, right? So just, you don't have to use the complicated form of CIP, right? You just need to use the approximated form, and you should get pretty much the same intuition, right? So if this numerator is negative, right, then this difference is negative, right? And therefore, we're saying that R star is greater than R. So the euro interest rate is greater than Japanese interest rate, or what B says, right? Japan is less than in the Eurozone, right? The interest rate in Japan is less than in the Eurozone. I'm done. Okay. All right, comments, questions. So check the slides if you don't know what this is, but I think everyone does. So let's move on. All right, quiz question 3. The carry trade is most likely to be profitable when A, uncovered interest rate parity holds, B, the uncovered relation is violated, or C, the forward rate is biased estimator of the future spot rate. Okay, so carry trade. Carry trade, check the last slide of the previous lecture. I gave you a whole definition of what that is, but to summarize, a carry trade is trying to exploit interest rate differentials, and what they do is they try to find countries with low interest rates, and they borrow at that interest rate, and they go long or invest in countries with high interest rates, and they're hoping that this UIP doesn't close, right? There's no convergence. There's not sufficient enough convergence of the appreciation or depreciation of the home currency such that it wipes out their interest rate differential gains, right? If they go the opposite direction, that's even worse, okay, right? Because that would inflate their liabilities or deflate their future asset returns, right? If it goes the opposite direction. So if uncovered interest rate parity holds, what does that mean? We learned from last week. If UIP holds, that means that under those conditions, in which UIP should hold, on average, investors should make zero profits, right? Then that would mean that the carry trade is not very likely to make money, right? On average. So A is not a good answer. It doesn't mean that carry trade doesn't make money, right? It's a statistical argument, right? On average, maybe there is an iteration, a random event. I mean, one event that in which you do make some money, but if you repeat this event over and over again, on average, you should get nothing. So A is not a good answer. Okay. B, the Fisher relation is violated. So if you don't know what the Fisher relation, then it's fine. Okay, you can just skip it. So some people chose B. I'm guessing because they don't know what that is, and they probably think that C is probably didn't know what C meant either. Okay, so the Fisher relation just means that you can decompose nominal interest rates into two parts: a real component and a inflation component. In other words, after you subtract out inflation, there's some sort of fundamental interest rate that's not impacted by the money creation of money supply, for example, right? That has nothing to do with the profitability of a carry trade. as far as I can understand. It's not, the relation is not, the fact that this is true tells me nothing about the profitability of the carry trade, right? For example, if I just take UIP and I decompose it into R plus pi and R plus pi star, both stars, it tells me nothing, right, about whether or not UIP is violated. So the given that Fisher is violated just means that maybe there's an extra term, fine, that doesn't mean anything, right? Just means that there's some residual that's not accounted by R and pi. Okay, so this, not a good answer, but I don't know. Some people might think it's worthy of a candidate. So, but let's read C. The forward rate is biased estimator of the future spot rate. Okay, so this clearly states that F is not a good approximation for E hat E, right? Expected E hat E, and which means that one of the assumptions perhaps in UIP is broken, and therefore R is probably not the same as R star plus blah, right? Whatever, the rest of the terms. In which case, perhaps banks that are more risk tolerant, they may make some money, right? On average, it's possible. So just given the more direct, explicit suggestion or implication of C, I think C is a better answer than B. All right, so this is pulled from a CFA textbook. Okay, so I think this is the better answer too. Okay. All right, so I gave you the definition of Fisher relation. We'll come back to this relation actually soon. I think week 5 I will talk about this again. But there's a difference between this Fisher relation and what's called the international Fisher relation, which I'll show you after the week after Chinese New Year. Okay. So the violation of the future, the violation, C is basically saying that the unbiasedness hypothesis is wrong, right? So we talked about this in class, and yeah, it should have rang a bell once you read the question. All right, comments, questions on the quiz? All right, so our next agenda item is to go over ungraded problem set number 3. So this, it's only one question, and the first 2 questions is just testing your understanding of how to use UIP and I think CIP, right? And then asking you to regurgitate, why there's this difference between UIP and CIP. Why is UIP called uncovered and CIP called covered, etc. Part 3 requires you to dig deeper, so you should go ahead and try to download the data yourself and try to empirically verify that CIP and UIP is either holds or it doesn't hold, okay? And just to give you a heads up, some people are confused about this statement here. So this says the expected future spot rate. You can assume that the expected future spot rate is simply the spot rate, the realized spot rate 3 months ahead. So what this is saying is I'm assuming that investors have perfect foresight, right? It's as if they can see the future. I'm just simply using the spot rate that comes about 3 months ahead. I know something about it today. So obviously, if I were to look at E hat E equal to E plus T to T plus 3, I can't do that today because the data is not available. But 3 months ago, right, I could use today's E 3 months ago, right? So maybe I'll give you an Excel example just to make sure people are not, don't think I'm crazy. So imagine we have, I think it's monthly data. So let's do 2020. All right. So no, that's not right. Yeah, it's a like this format then? No. This okay, let me just write out some numbers. This is March. This is April. Sorry, I'm writing it US style. Okay. So if I put the month first. All right. So if you have this is the spot rate, so that's ET. And to proxy for future E, so I'm going to use E hat E to represent equal to E underscore T plus 3. So if E is 0, I mean 1.2, 1.3, 1.4, 1.5, 1.6, then I'm simply saying that this number is 1 month, 2 months, 3 months ahead, right? So it's as if I have perfect foresight. Of course, I have to fill in the future. Make sense? So when you test it, when you test UIP, you can replace E hat E, expected future spot rate 3 months ahead, equal to the actual realized spot rate 3 months ahead. So this is exactly right. If today is January, I'm assuming that the spot rate, I know with certainty what that is 1.5. And I'm assigning it today. So when you test UIP, you will use this number to test it for January. Right? Make sense? All right. All right. So yeah, go ahead and play with the data at Bank of England. And your findings, I think, should reflect what I told you last week, that UIP is routinely violated. And obviously there's fluctuations. Sometimes it's really, the gap is really, really small. I mean, the error, right? When you take the difference between the left-hand and right-hand side of UIP, you hope the difference is 0 on average, but it's not. It fluctuates over time. And so some people who are lucky and they can predict where the error is going, they could make some money on average, right? All right, so let me go over the first 2 questions, which are just involve simple calculations. Why is uncovered interest rate parity called uncovered? Does it have to hold? What assumptions are needed? How does it compare with the covered interest rate parity? All right, so CIP, it's different from UIP because it has F. And what does F do? F eliminates future spot risk, which UIP does not, right? That's the main difference. CIP is maintained, or it must be true, if you only assume on one condition, that there's no arbitrage, right? Law of one price holds, no arbitrage, same thing, then this must be true. This equation must be true because there's no risk and you can construct a investment sequence of investment strategy steps that requires no investments and yields a potential positive payoff if it's violated, right? On the other hand, UIP requires 2 things, right? 2 additional fairly strong assumptions. Number 1, market efficiency. Again, not in the sense of transaction costs per se, but more of perfect or symmetric information, meaning there's no discrepancy, the market is able to know and aggregate both private and public information. And so just simply looking at the prices today, you can kind of get a sense of the reality of in the future for the spot rate. All right, so with this assumption, you get rational expectations, right? Because on average, if the markets are able to incorporate everything about the future and people can view the markets, update its prices continuously, instantaneously, then we should be pretty good at forecasting the future. So on average, our beliefs are correct, right? And therefore, therefore you don't need F, right? Especially if you're risk neutral, you can simply exchange F for E, because all you care about as risk neutral investors is average returns, right? That's all you care about, average returns. Other sorts of risk premia, you don't care, right? Because you're trying to maximize the most average returns as much as possible. And if UIP is violated, then on average you have positive returns, then somebody's going to come in, try to make something, right? Trying to make something on average that's positive, and that will close the gap, right? That will close the inequality and restore parity. So while the mechanism, right, that you need traders to come in to restore this parity, the incentives are different. CIP's incentives involves simply free money, right? That's a very simple assumption, and it's the most robust, and you can verify this empirically. UIP, on the other hand, you have to have two fundamental assumptions in order to get this incentives to bite, right? You need these traders to think in a certain way, and they have to be able to forecast prices in a certain way so that their beliefs are on average correct, and on average they can make money. Otherwise, they would never ever try. I mean, they're less likely to try, and therefore UIP may not be restored. So that's a brief summary. Again, it should be, you can dig it up again in your slides. All right. The second part is just asking you to plug and chug, right? So meaning that if you know the equations, you identify the inputs, right, and you can easily verify the other missing parameter, the other unknowns. So let me read question 2. The USD 3-month deposit interest rate and the 3-month deposit rate, pound sterling deposit rate, are both 5%. So you have R and R star, so you don't even need to assign foreign or domestic anymore here, right? They're both the same at 5. What is the relationship between the current equilibrium of the price of pound sterling in terms of dollars exchange rate and its expected future level? So that's quite easy, right? You just realize that R minus R star equals 0, and therefore the expected depreciation of home currency must be also equal to 0, right? So there should be no change. Assume the expected exchange rate 3 months into the future remains constant at 1.5, okay? But the pound sterling 3-month deposit rate doubles to 10%. So now there is a differential in interest rates, and you know that the spot rate is expected to stay at 1.5, and it's asking you to solve for, the future rate is 1.5. It's asking you to solve the new spot exchange rate today. Okay, so let's go ahead and just plug and chug for that, right? So here we've plugged in 5%. Therefore, expected future rate equals E, so the expected depreciation is 0. Second question, you assigned future expected spot rate 1.5, interest rates because US dollar is the numerator. Therefore, 5% for US and 10% for foreign currency, the bank deposit rate. And you just solve for E, right? And you see that E gives you this number. And then that's it. All right, so I'll leave you to look at the Excel answers on your own, but I think again it's fairly simple. You just try to compute the difference on the left side and the right side of UIP and CIP, and just verify that the difference is close to 0 or changes often as you go through time, right? In which case something's violated, right? Something doesn't make sense. Okay. So before I start this week's lecture, let's review a bit about multivariate calculus. So I'm not gonna test you on like taking derivatives, but it's important when I use certain expressions. For example, I use this cursive D here to represent partial derivatives, meaning that I'm going to try to hold certain parameters constant in the function and then try to understand how infinitesimal changes in a certain parameter impacts the entire functional value. So maybe I'll give you an example of what that means. All right. So suppose we're trying to model something and it has two inputs, R and Y. So you kind of already know what this is, right? I'm trying to model demand here with two parameters, two variables, R and Y. Okay. Don't worry about this for now. Okay. So if I assign a functional form, let's just say it looks like this, then we can actually plot this function in 3 dimensions. And your question should be asking you, okay, I know it looks like this. How will I know how the lines, how the graph looks in 3 dimensions? Well, the trick here is you just hold one parameter constant and try to understand the curvature, the slope of the graph first. Then you move on to the next parameter and you try to understand the relationship between Y and L in this case, right? So in other words, let me say that again. In order to understand what L looks like in a 3-dimensional space, we hold a parameter constant, so we can hold Y constant, and we change R by a little bit to see how L changes. Is it positive or negative? So if it looks like this functional form, so -1 means the inverse, so 1 over R, okay, and 1 over Y. And let's assume that R and Y are both positive on the positive space. Then if we take the derivative of L with respect to R, it will look like this. All right. I think taking the derivative of this variable is quite easy, right? I hope there's some exposure to the calculus because you must have done some calculus last semester. So any case, taking the derivative of this expression, you'll see that it's negative, right? Because it's a -1. And R to the -2 is always positive because we assume R is positive. In which case we understand now that higher interest rates, so if R is higher, then it becomes more negative. So the lower demand for cash, right? That's how you interpret this expression, right? So sometimes I'll say partial L with respect to partial R. That just means I'm looking at the partial derivative of liquidity demand or cash demand with respect to a minuscule change in interest rates. And if it's negative, it means that there should be an inverse relationship between R and L. Okay. So if it looks like this, and I have L on the y-axis, R on the x-axis, then it should be what? Downward sloping, right? If L is positive going this way, it would look like this, right? All right. I don't want to confuse you too much for now. All right, so that's how you do that direction. For the other parameter, I have it specified as negative Y to the -1. So again, we're holding R constant and looking at the sensitivity of L with respect to Y. The negatives becomes positive. And so this is always positive. So this tells you that the relationship between cash demand and income is always positive, which makes sense. You expect yourself to be wealthier. Even if it's a lump sum drop like a lottery, or you expect yourself to be wealthier in the future, you're going to try to spend more money, right? So you're going to demand more cash. You might sell move some of your savings to cash. That's like selling bonds for cash, right? In which case you can spend the money today, right? So this is shifting liquidity. So I will talk about this later, okay? But that's the idea. So if I were to plot this graph with L on the y-axis and Y on the x-axis, this would be a positive sloping curve, right? All right, so if you combine this L with R and Y space in the same graph, it looks like this. So you can see the trade-offs, right? The relationships. So X here is our R and Y is Y. So let me just write an R here, okay? just to avoid confusion. This is an R. So what this is saying is that, let me write R here. So you'll notice that the lines go like this, right? So why are there so many of these lines? It's because we're holding y constant, right? If we hold y constant, then the relationship between r and y is negative. So that means that as we increase r, so increasing r goes this way, we're increasing r, we're going this way, then y becomes, so L becomes higher. Sorry, when we lower, right? You don't demand as much cash if interest rates are super, super high, right? If it's 20% interest, right? That beats most equity returns. You wouldn't hold any cash. You would just move it all into bank deposit returns and bank deposits, right? So higher R, lower liquidity demand, right? So because liquidity demand is going this direction, right? Liquidity preference, right? Your demand for cash is going this direction. So the higher the R. Sorry, let me see. Maybe I'm confusing myself. Let's see. Higher R. Yeah, that's right. Yeah. Higher R, lower liquidity. So towards zero, right? This is zero. So I'm confusing myself. Higher R, you're closer to the axis. Yes. The opposite is true going the other direction. So we'll go over this later, okay? But just to give you an idea how to plot these relationships in a three-dimensional graph. But we'll be working with 2D primarily. All right, so higher R, lower cash demand, lower R, right, closer to zero, then higher cash demand. So that's why you see these curves going this way. But you see a lot of these curves because we're holding y constant, but if we change y, that relationship's still preserved, right? If we hold r constant, we can see that there's a positive relationship between L and y. Why? Because for a given r, with more income, which is going this direction, we should demand more cash, right? So that's why you get these lines here. So you kind of get the idea now, right, of what this preference shape, right? This liquidity preference shape looks like in three-dimensional space. Okay. So we'll be always working with something simple, right? We're not gonna try to model L. So I gave you these functional form just for the sake of plotting. Okay, so this is what I'm plotting is this. Okay. But we're simply gonna impose enough assumptions so that we can take the derivative, so that we can know this, right? Because we want to know how cash demand changes with respect to these incentives, namely the opportunity of holding onto cash and how much money I'm making in real terms, right? All right, so I hope I didn't lose people when I talked about this. But anyways, we will come back to this very soon, and I hope I won't lose people when I do. All right, so let's get on to today's lecture on monetary policy and exchange rate determination. So today's lecture is trying to combine the relationships between central banks and FX rate determination. All right. So the monetary approach just means that I want to know how a central bank's balance sheet and changes in its balance sheet impacts other countries' balance sheets potentially, and also the exchange rates. Okay, so in other words, it's a system of balance sheets between central banks and how that impacts interest rates and how that ultimately impacts exchange rates. All right, that's what we're heading. Understanding how balance sheets changes in central bank's balance sheet impacts interest rates requires our understanding of exactly what is happening when a central bank decides to change its balance sheet. Okay, so we need to understand what bonds, specifically government bonds, are. Okay, so we need to talk about bond prices, its relationship to bond yields. So bond yield is just another fancy word for interest, average return of holding onto a bond until maturity. And that will give you an idea of how interest rates are set. Once we understand how interest rates are determined from this network of central banks, we will split our analysis of exchange rate determination in two different dimensions. One is between short-term and long-term. So this is specifically referring to whether or not we're holding on to, or we're saying that P is a constant or not. Okay, so in the short term, we will typically assume that prices are constant. The fancy word in macroeconomics is sticky prices. So it's exactly what you think it means. It means that changing prices in the short run is expensive, and people don't usually change those prices immediately, okay, in response to central bank actions. It usually takes quite a while, maybe a few years. And so once we get to the so-called long-term period, that's when prices reflect all the monetary policy, money supply changes that has occurred. All right, so that's the split of our analysis in that dimension. The second type of dimension is temporary and permanent changes in money supply. So this is maybe harder to understand, but let me give you an example. A temporary change in money supply is something that occurred during the financial crisis or during the pandemic. People don't expect central banks to maintain such a large liquidity supply in the system forever, right? It's not going to be forever. They expect people to undo those policy changes before we get to the very, very far into the future. In which case, you shouldn't expect your beliefs to change very much, right? If we're talking about 10 years away from the pandemic, right? Because anything that occurred during the pandemic is going to be undone before we get to the 10 years, right? And so our expectations in 10 years shouldn't move at all, right? So temporary is referring to any sort of policy that's eventually undone before we get to the future, like the far future. Permanent changes is like countries that decide to monetize their debt. Have you heard of that before? So that literally means that a country is retiring their debt by simply printing money. Okay, if I retire my debt permanently, a country can simply print money, buy the debt with the money from the markets, and hold on, and then just never the public will never touch it again. But you have to maintain that amount of money in the system forever, right? If you undo it, then you're lending. I mean, you need to borrow money again, right? Because when you put the bonds in the market, if you put sovereign debt in the market, you're basically getting a loan from somebody. But if you print money to buy your own debt, you're buying back your debt. But you have to keep the money in the system forever, right? So that's what a permanent change in money supply is referring to. So, yeah. So as you can imagine, temporary and permanent, very, very subtle differences, right? But the main difference here is there's a change in expectations, right? That's the difference. So for 3, we have change in prices, right, between short-term and long-term. But for temporary versus permanent changes, we're actually talking about change in expectations. So if it's temporary, far into the future, my beliefs still maintain the same, because anything that changes in the interim period, short run, medium term run, doesn't matter because it's going to be undone. Doesn't affect my beliefs about 10 years later. Permanent changes is forever, like monetization of debt, right? If you know Argentina is going to monetize their debt, they're going to print buttloads of money to buy off all their debt, then you know there's going to be hyperinflation forever, right? 200%, 300% price increase. That's going to change your beliefs for sure, right? And that has to be reflected in your expectations, right? That's the idea. Okay, if that didn't make any sense, that's fine. You'll see the math. Okay, you'll see the math very soon. So our objective is to combine the model of money and foreign exchange markets. So the money market refers to how much money is going to be circulated in the system. And again, this is basically the market for sovereign debt, U.S. Treasuries, Chinese sovereign debt bonds, Euro bonds that's issued by the EU, etc. Okay, these are government issued bonds, and these are the next best alternative investments with your cash, right? If living in any country. If you don't want to hold on the cash and you want to earn some interest, the next safest investment, right, for the same amount of risk, comparable amount of risk, is putting in the bank or buying, which is backed. These bank deposits are always backed by sovereign debt, right? Portfolio of bonds. And so by doing this, we can therefore link R with E to the money market, right? Because money demand equals money supply will determine what R should be, right? And once you have determined how R is determined, you know how E is determined, and that's done through UIP, okay? All right, so I don't think I need to talk much about money, right? You know why money has value. Medium of exchange, this means you can use money to trade goods and services. It's a unit of account. You can compare value between goods and services, etc., and it's store of value, right? And as a government, you want to have the ability to issue your currency. This is like a privilege. Every country should want to have the ability to print money because you can change the path of your economic growth, for example, right? Only under dire circumstances would you outsource that to another currency, another country. Like if you're a small developing country, for example, and having a central bank is too expensive. All right, so money is an asset, obviously, yes. Its returns are small and negative if there's inflation. Yes, because inflation eats away at bank deposit returns, right? Through money supply or through too many goods, too much demand for given them. You don't have enough goods and services to fulfill the demand, right? Then you get inflation that could eat away at you have runaway prices, which could eat away at your purchasing power, right? Risk, not different from inflation deflation, but we're going to assume that it's negligible. Another source of risk is default risk. I guess for most developed countries, that's again not an issue. And liquidity, very, very liquid asset, right? You can buy literally anything with it. Almost everyone accepts it. Maybe not so much in China because everything's digitized, but you still have digital RMB, which is basically the same thing, right? With the exception during hyperinflation, right? So you only get this scenario if your country monetizes all of their debt, right? This has happened too many times already in South America and in Africa. Okay, but other countries that are responsible, okay, this won't happen. All right, so how do we determine your demand for money as an asset? Well, it depends on your next best investment, right? Your alternative investments determines whether or not you decide to hold on to cash. So opportunity cost refers to the amount of value or return that convinces you to part with your money, right? So what's the marginal return that convinces you, persuades you not to hold on the cash today? That's your opportunity cost, and that's going to be determined by interest rates. Okay, so if bond rates are high, like it is now, people prefer not to hold on to their cash and make investments in the stock market. Maybe it's not worth it anymore, and you just move your money to a bond portfolio. Okay. So maybe I'll write that down just to emphasize point. So if you have increase in R, then increase in opportunity cost of money, which means money demand decreases, right? So R is the return, your next best investment return. With higher R, a lot of you or some of you will be persuaded to part with your money today and put it in a bank account, right? Bank deposit. Bank deposits are all linked with bonds. And so you can think of it as using your cash to buy some bonds, which will affect bond prices and therefore bond yields and so forth. Okay, so that's the mechanism I work here, right? So money demand affected by next best alternative investment, which is bonds because it's safe, it's riskless. And if R changes, that could convince me to part with my money today and put it somewhere else. All right, so who changes money supply? Who controls money supply? Money supply, as I said, is usually controlled by a single financial institution in a country. And that's a sovereign right. And I think if you try to print your own money, you'll get in a lot of trouble. Okay. So supply is easy to know in our model now. Okay. So remember, our objective is to kind of come up with a model in which we get this, right? And how is money supply determined? Well, it's determined by one single entity, and it's literally just a fixed number that this bank decides to set. So we don't have to model it, right? It's just a fixed number that the central bank decides to set. So we're basically done. Okay. So exactly what money supply is? Money supply refers to several things, but it's important to talk about something else first called a monetary base. Okay. So monetary base is cash reserves at banks, as well as currency in circulation. And also excess reserves. So cash reserves, let's just say required cash reserves, okay? Okay, so you can kind of, I hope people have some idea of why there's requirements to hold on to cash at banks, why central banks would want this. So some background on banking. Banks serve a purpose in an economy. Their job is to eliminate asymmetric information so that people can make investments through these banks. You put your money, you deposit money, but what do banks do with your money? They make investments, they lend it out. And so these financial intermediaries want to take your money so that they can make investments, and you get a little return on those bank deposits. But sometimes central banks don't want too much lending, right? Because there's money creation when you lend out money and that money get deposited somewhere else, etc. So there's a money multiplier effect. Central banks therefore would like certain banks or all banks to maintain a reserve ratio, meaning some cash, so always have some cash at hand. And so that curtails the money multiplier effect. So monetary base includes that required cash reserves, some ratio, right, that must stay at banks, the currency in circulation, and also any excess cash that these banks are holding on to beyond the reserves. All right. So that's probably the most fundamental measure of money supply. But money supply actually involves more than just that now. Okay. So money supply is an expansion of monetary base to deposits, commercial deposits. So let me tell you what those things are. So money supply now includes M0, which is monetary base plus bank reserves. M1 is M0 plus demand deposits. So this is like checking accounts. Okay. M2 is M1 plus savings. And M3 is M2 plus time deposits. So like fixed term deposits, like a bond, right? So when we're talking about, when I say money supply, if you want to take it in the strictest sense, I'm talking about everything here, okay, M3. But a lot of times I might use monetary base and money supply interchangeably, but the idea is the same. I'm trying to account for people's demand for holding on to savings, holding on to liquid cash. The difference between M1, M2, M0, and monetary base is not that important in this class, but if you get interviewed in a job, you might be asked this question. Yeah, now you know the difference. Okay, so now we know how money supply is determined. It's determined by the central bank. The next question is how does the central bank go about changing money supply, right? So there's two basic ways to do this. One is through, as I said earlier, deposit requirements. So that's the reserve ratio I was talking about. Sometimes it's like minor interest rate, like discount windows that people may use to borrow and lend money. That's also determined sometimes at will. But we're more concerned with big, like large scale changes in money supply. And so when I talk about changes in money supply, I'm not going to be referring to these things. Okay, these are just minor things. I'm going to be talking about this open market operations of transactions. So these are like interventions directly in the bond market to buy and sell sovereign debt, U.S. Treasuries, PBOC issued bonds, European Union issued bonds, etc. Okay, so these interventions in the secondary bond market to swap cash for bonds. This is what I'm talking about when I'm talking about changes in money supply. Okay, this is not entirely accurate, but for the sake of this class, I think it's still a reasonable assumption so that you can understand how exchange rates move. Okay. All right, so let's try to visualize what happens when a central bank decides to engage in what's called open market operations. So let's look at, to visualize that, we need to look at their balance sheet, right? So let's look at their balance sheet. I'm not an accountant, and there's no reason for you to associate this task with accounting, but when you see a balance sheet, there's two sides to it. There's an asset and liabilities, and assets has to equal to liabilities, right? According to accounting. So for sure, these two sides must be equal in value. Foreign assets and domestic assets are two types of assets, so I like to partition them. So let's go ahead and do this. You'll see why the difference between foreign assets and domestic assets matter later on, but for now, for most central banks, you can divide their holdings into two distinct parts. Domestic assets specifically refers to domestic debts or debt-like contracts that are safe. So for a long time, mortgage-backed securities were considered safe, and you can think of them as domestic assets, right? Foreign assets can include foreign currencies, foreign debt, etc. And these other assets, gold is an asset. SDRs stand for special drawing rights. So if you're studying banking, you may see this term around. So this is like an asset that's created by the IMF. Okay, and it's supposed to facilitate interbank lending between international central banks. Okay, so you can think of it as a universal currency, although they don't say it's a currency. But the idea is that if you want if you want more dollars, if you want more Chinese yuan, you can exchange SDRs for that currency. Okay, so that's what SDRs is for. It's like an intermediary asset in which you can give another central bank more of that currency if they need it, and they would just give you SDRs. Okay, and you earn interest on this SDRs too, and it's all paid by and run by the IMF. It is backed by GBP, USD, CNY, and JPY. It may be euros, but I think for sure those currencies. All right, and net worth is just, if your asset size exceeds your liabilities, this is the surplus, right? So this is like yes, shareholder surplus, shareholder equity. That's the analogy here. Okay, so this is the difference between asset minus liability, market, right? So maybe I just write market difference between asset and liability. I'm not going to get into the book value, market value stuff. That's for your corporate finance class. Okay, so monetary base or money supply, whatever. Liability side, it's clear, right? We understand now that money is just debt. When I issue money, and someone accepts it, they're expecting either a return or I export them something in the future, right? They have the ability to buy stuff from me if they take the cash. So it's going to go on the liability side, right? Our cash, the home country's cash. All right, so for now, don't worry about this at all. And don't worry about this. We're just going to keep things simple. Just monetary base and foreign and domestic assets. But we're going to be focusing just on this type of asset for today. Okay, so assets still equal liability, but we're just assuming there's no difference, there's no net worth difference, and we can partition foreign assets and domestic assets, right, to different types of assets. But when we conduct open market operations for today, we're just changing this side and this side, right, as a result. So if we were to conduct open market operations that, in this example, increase the monetary base or increase money supply, what does that mean? That means that we are expanding the liability side, right? But as we all know, liabilities has to equal assets. So what that means is that if we create money, we have to use that money to buy something, right? So we typically would buy bonds, right? So printing money expands the liability side. With that money, I have to buy an asset. So if I want to affect interest rates, I would want to buy the asset that affects interest rates the most, which is sovereign debt or US Treasuries, blah, blah. And if I buy my own debt, that's going to impact bond prices. And if bond prices are affected, that's going to affect bond yield, and as a result, interest rates, right? And the sequence of logic is the following. If I buy domestic bonds, bond prices rise, which means that bond yields or interest rates decreases. So I'll show you a formula just in case you're not convinced, but I think you should believe that given your exposure to corporate finance last semester. And that will mean interest R decreases, right? So now you know how quantitative easing works, right? Quantitative easing literally means large-scale asset purchases to move interest rates downward towards zero. And when you do that, obviously bond prices rise for sure because you're going to buy those domestic assets. When bond prices rise, the mechanical relationship between price and bond yield is going to decrease. And as bond yields decreases, that means the return of holding on to these assets decrease, and as a result, interest rates decrease. And that's how you get lower interest rates and easier credit, right? So this is a positive change, right? Let's make sure. All right, comments, questions on how central banks have a balance sheet, what's on their balance sheets, where does money go on their balance sheet? If a central bank wants to print money, what also has to happen so that assets equal to liabilities? What sorts of assets that's purchased will impact interest rates, and why those interest rates change is because of the mechanical relationship between prices and bond yields. All right, so money supply, as I said already, very easy to model. It's just a fixed number that the central bank decides to set, whatever that amount is, $100 trillion worth, whatever. But money demand is a bit harder to model. So here's the idea. Money demand is equal to the amount of average things you want to buy times the average price, right? So you can think of P as the average price and L, as you saw before, as our functional form of the average quantity of, or baskets, number of baskets that we want to consume in the overall economy. So maybe from your microeconomic study, you learned that P times Q equals, total expenditure. So same idea here. P times Q, right? Price times quantity should give us total money demand required for whatever, to buy, to invest in things, whatever. Very simple model, right? Price times quantity equals money demand. Price level, if you want to use real data to represent these things, price levels is CPI, right? R, we know it's interest rates. So just look at the treasury yield curve, look at the interest rates. You can pull out R. Real national income is just GNP. L function, we're not going to try to model, but that's not important. All we really want to know is the change in R and how does that change Y. Okay, just that relationship. Okay, so as I said before, the relationship between L and R should be straightforward, right? As I increase R, the cost of holding on to cash increases because I'm foregoing the additional returns I can get by saving. So the higher the interest rates, the less likely I'm going to hold on to cash and therefore negatively impact this L function or liquidity preference. So I'm going to write a minus sign here, but you can also say that the partial L with respect to partial R is negative. The relationship between L and Y is, I think, also straightforward. The wealthier we are, either in right now or in expectation, means that we'll most likely increase our consumption because we're richer, or at least in expectations. Then I'm going to move some of my money out of savings and buy a Lamborghini if I'm expected to be a millionaire, get $1 million next year or whatever, right? So it's positive relationship. If I'm wealthier in real terms or in financial terms, I'm more likely to want cash today to satisfy my demands, whatever it is. Okay, so given this linear breakdown in which we can factor out P so easily, right? Then we can simply scale both sides, divide both sides by P, and just work with this functional form, right? MD over P equals liquidity preference curve. So this is sometimes called real money demand or just liquidity preference. So partial L, partial Y is positive. So let me write intuition in case people get lost. Higher opportunity cost, less money you want to hold. Higher income means you can consume more today and increase money holdings to spend, right? So equilibrium in this money market is simply fixing MS over P equaling to liquidity thresholds, right? So that's going to represent our money market, right? Because as economists, we like stable points or equilibrium. Market clearing, right, is when supply equals demand. So when money supply, the supply provided by the central bank equals to all of our demands for liquidity, then we get stability, right? Nobody wants to move money anymore. Nobody wants to sell anything. So that's going to be our fair value of R or R or Y. Everything's stable. Right. Before moving on, comments, questions. So I hope, again, these, don't worry what the functional form of L is. I'm not gonna give you a functional form, maybe never ever in this class. What's important is the understanding the relationship between L and R and L and Y. Forecasting is very important, and what's important is your ability to understand the direction of where E and R goes. That's most important, because part of your job maybe in the future is to digest macroeconomic news, and you need to give reasonable forecasts, at least directional wise, where these variables are going. All right, so the next part is just review. So I say bond yields. So yields and interest rates are not exactly the same, because yields is like an average return you get from holding on to the bond until maturity. Interest rates, you can get interest rates from the bond yields, but you have to factor in coupon payments, right? I think you learn something from investments, hopefully. Okay, so this is just review. So a bond has basically two characteristics, right? There's a coupon rate or a discount rate and a par value, or the loan amount, right? So if a bond has a face value of $1, just means that if you were to sell this bond and someone buys it, it's as if the person is lending you $1, but you have to pay an interest or a coupon payment on it, right? So the simplest bond has 0 coupon payments, right? They just pay a final return, a discount rate at the end of the period. So that's the most simplest bond, okay? Bond trades at a discount, as I said, and makes sense, right? Because time value of money. So at a discount rate of 20%, then a dollar bond costs 80 cents. So 80 cents on the dollar. So another way of saying this is the yield on the bond at 20% means that R, the return is 80%. Sorry. The discount rate tells you about the price. Okay, sorry. So 20% of $1 is 80 cents, and you want to find the yield, the average return on this bond. You can, and this is over one period, say 1 year. Then you can easily solve it by setting the price equaling to the par value divided by the return, right? The periodic return you get on this bond. So solving for R gives us a interest rate of 0.25, right? So based on this equation, right? So remember, this is the present value or price, and this R is called the yield. Okay, let me type it out. Yield. So when prices rise, so in the case in which there's asset purchases, right? Then in order for this right-hand side equaling to the left-hand side, R must move in a direction that restores the equality, right? And in the case of the left-hand side increasing, R has to decrease, right? So that the entire right-hand side expression increases. So that's why you get lower yield, right, from asset purchases. So you can obviously test this easily, right? So rather than looking at the discount rate changing to now 10%, in other words, prices equaling to 0.9, you can easily see that the bond yield decreases to 0.11 instead of 0.25, right? It's a decrease. All right, sorry for this trivial exercise, but just to convince you that there's a mechanical relationship between bond prices and bond yields, and therefore interest rates. All right, so as promised, I told you I would show you everything in three ways. One in economic intuition through words, second through the math, and third through graphs. The graph that's relevant here obviously needs to involve interest rates as an axis, and therefore the other axis is going to be the new functional form, the part that we had a model today, which is our liquidity preference function. So as you can see, you saw this before, right? You saw this before in the other graph. We have L here, R here, and we know that there's a negative relationship between L and R. And so we want to look at this only at the cross section. So we're going to hold Y constant, right? And then we get a 2D graphs. In other words, we're just looking at these lines here, right? Just these lines. So that's exactly what we're going to do here. Let's just hold our Y constant. So kind of ignore what the Y value is, whatever it is. We want to understand the shape of this curve, and the intuition again is R is your opportunity cost of holding on to liquid cash. So the higher R is, the less likely you want to hold on to cash. So very, very high R, you don't want any cash, right? So you're up here. If interest rates are 0, then there's really no reason for you to store money, otherwise storage fee, right? The storage benefit of holding onto cash in the bank. So you're really indifferent between holding onto cash and putting in the bank, and therefore you're maybe somewhere here. And so it's going to be a downward sloping curve, or it could be straight line, doesn't matter. We didn't specify the model, right, of L. So as long as it's downward sloping, it's good enough for us. So intuition, I'll give you some points here to highlight the intuition, right? So here you have very high R, so high opportunity cost. Just high R, and then low R. Very, very low R. It means no benefits, right? To this low opportunity cost. And yeah, so this is just saying it's negative, right? Okay. So far, very simple, right? So the next question is, how do we express or represent a money market equilibrium in which money supply, now in terms of real terms, right? and just say MS equals money demand, right? That's our way we want to visualize this. Well, we already have our representation of money demand, which is just liquidity function. So let's go ahead and just draw that. And as I said earlier, money supply is set by just one financial institution. It's just one number. So what does that look like on the graph? It's just a vertical line. Just do this. That. And I'm going to write MS over P for real money supply. And then I'm going to write LRY for our money demand, real money demand, or liquidity preference. Therefore, equilibrium, stable interest rates, or interest rates are stable at this intersection here. And this is going to be our R that's going to feed into our UIP equation, right? So now we have another set of equations we have to think about, right? We have R equals R star equals expected depreciation of home currency. And now we have this one more equation in which MS over P must equal to L, right? So the next question you should be asking is, great, I have a model to represent how interest rates are being set. I have also an FX returns market model. And now I can read macroeconomic news in the newspaper and kind of determine or predict how R or E should move, right, as a response. And this is, right, things, if you have been following the news often, right, people are always guessing when central banks are going to change interest rates. And depending on your own beliefs, right, if you're a FX trader for a hedge fund, you have privileged knowledge perhaps, you can perhaps accurately predict how expectations are going to move, and that could, help your forecasts. So what happens when we increase this, right? So let's do our first policy analysis. What happens when we have real national income increasing? So why would you think about this? Well, suppose you're China and you know that China might be spending, conducting a open market operations to buy certain assets to stimulate the economy, perhaps. And or maybe not that. Okay, maybe that's too monetary. Maybe think about something more specific. Maybe there is a artificial intelligence boom in which certain companies make a lot of money and everyone's wealth on average increases, right? In which something's going to happen to exchange rates somehow. And we need to think about how that impacts interest rates. And let's do that first. So as usual, we will start with a stable point first, and then do some curve shifting afterwards. So let's start with a money supply curve. Sorry, money demand curve, along with a money supply curve. So I'm going to write LR here, LRY here, and then I'm going to write MS over P. We have a initial market clearing point that will set our initial interest rates. So let me write R here, and then let me specify this as R naught, okay? So let's work through the math first to see what happens. So if we expect, on average, people's wealth to increase in the near future, we can do a thought experiment in which we look at the Y variable increasing we know that y is positively related with what with L. So if y increases, L increases. This is going to create an inequality in this way. Assume all else equal. We can't change anything here because this is set by the central bank. Prices are assumed to be sticky. Then the only other parameter is R. So how do we restore equality? Well, that can only happen if this moves in the direction that is the inverse of L. So we want L to go down, and that's only possible if R goes up. So we should expect interest rates to rise as a result of income rising. All right, so we didn't move MS over P, so let's just say it's this point here. That means that if we do increase Y, then we should have higher interest rates. So boom, here. But in fact, we kind of set MS over P as a arbitrary point. So no matter which MS over P we choose, it could be here, it could be here. I mean, this point here, doesn't matter. The entire curve has to shift actually, right? So we get a elevated curve. I'm going to write L R Y prime, okay, to indicate the new level. And we have a new equilibrium, money market equilibrium. And that is our R prime. All right, so mathematics is devoid of intuition here, right? I'm just telling you that if something changes, in order to get equal sign, you have to change other variables to make it equal. That's not so interesting. So what exactly is going on here? Let's walk through the economics. All households are trying to sell assets, namely bonds, right? Because everyone's wealthier, everyone wants to consume because they're wealthier. Right? They convert things to cash so they can buy things, obviously. So they will raise liquid cash and dump bonds. So prices decrease and bond yields increase, right? And if bond yields increase, then your returns should increase from holding onto bonds. So R increase, right? If prices drop, that means if you buy in now, your return in the future is larger than before, right? And that's, you lock in that R, right? You lock in that R if you buy bonds today. So that's the economics. So the underlying assumption is that the partial derivative of L with respect to Y is positive, right? That's the only assumption we relied on. And of course, yeah, L is differentiable, etc., continuous. But anyway, that's mathematics beyond necessary here. Comments, questions? So I will walk you through all the other shifting later today. All right, so let's take a 10-minute break. I have a quiz for you again. Sorry. I'm going to pass it out. And again, just turn them in at the end of class. No need to submit them after the break. Yep. I did not. I'll keep track. I mean, you've been here every week. And you took the quiz, right? So I've tracked you. Yeah. Yeah. Oh, okay. Quiz?
Yeah.
Quiz?
I think it's me the last page I did.
Oh, it's you. Okay, it's you.
I remember that I read the formula on it.
Is this yours?
Yeah.
Just tell me your name.
Can I write it on my?
Just tell me
Okay.
which one's you.
I'm not this class.
Oh, you're not in this class.
Thursday.
Okay.
Oh, this is me. My name is Wang Yunpeng.
Okay. I'll just put a dot here. Okay, I'll keep
Thank
track.
you so much.
Yeah.
I remember this is my school.
Yeah, it's no problem.
Thank you so much.
Just remember to write your name.
Okay.
Professor, I have a questions on
Yep.
the concepts of the L
Yeah.
Y divided by P. So it is also named the liquidity demand. I personally have a question on it. What is its relevance to cash, or should it be rather related to all demands on, for example, like all kinds of investments, or just
Yes,
basically
it's
related to?
also, yes, it could also be related to investments, like speculative investments.
So it's not exclusively related to cash.
I mean, you would hold on to the cash
Yeah.
in expectation that there may be an investment opportunity,
Oh,
right? So if,
get it.
if it's zero, for example, if it's zero,
Yeah.
yeah, you want to hold them in cash because you might want to buy.
Yeah.
Like
Yeah,
equity or
so
something, right?
it's actually like it is directly related to all kinds of investments, considering that it is possible for investors to liquidize the investment at any time to gain the cash.
Yeah.
So it's finally related to cash.
Yes.
Okay. Thank you.
Yeah.
Also confusing about the concept of the liquidity preference. Is it just a conceptual thing?
Yes.
That's your tendency to hold cash or not hold it. In the contrary, if you don't want to hold it, you need to save it in the bank. Is that?
Yes, you can. So it's more specifically like like a checking account, demand deposit. So when I say R, it's you have to fix it X for a certain long period of time, right? So if R is like 1 year, then it's you have to put it in the account, but you can't touch it for 1 year, you can't spend it. So liquidity demand specifically here just means you're putting in maybe a low interest checking account, but you can withdraw anytime or to do anything else, right? To do whatever you want.
Oh.
So R is locking in your money and you can't touch it. That's what R represents.
They're locking up money.
Yeah, so it is abstract. So it's not literally a bank deposit.
Oh.
Yeah, because you do earn some interest and you can take out the cash any time. But if you want to be like, if R is not like month to month taking account of investments, it's like 5 years, then it's like putting your money in a CD, a term 5 year term deposit. I mean, you can't touch it, and it's locked in for 5 years. Yeah. So it's like buying a 5 year bond, which is a fixed investment, right? A fixed income for 5 years, and you earn that yield if you hold it all to maturity. But you can obviously sell it anytime you want, right? So CDs are basically bond portfolios. That's portfolio of these fixed, specifically 5 year horizons.
CB.
In the US, these fixed term deposits are called certificate of deposits. It's called something else in other countries. So certificate of deposit is just a fixed term deposit, which you're not allowed to withdraw, and you earn a high interest rate for that amount.
Okay.
Yeah.
Understand. And the second question about this part, can follow on this. I try to understand this. What is this
The
part?
intuition is what's the mechanism to get from this wealth effect, right? What's the mechanism where this wealth effect have impacts on interest rates? The idea is that if you're wealthier, so for example, like the example I give, if companies on average within the industry get wealthier, they share it with their workers, you have more income, and that higher wealth level means you're willing to spend more than before. And it's not, you don't necessarily have the money now, but you expect to have money in the far future, perhaps. You may shift some of your savings investments from illiquid to liquid cash.
Because you need to spend and consume it.
Yeah, you want to consume now, right? It's you save because you want to consume in the future, but wealthier, you expect to be wealthier. You are wealthier today, or you expect to be wealthier in the future. You'll spend today, right?
Oh, okay.
Right? If you were hired, if you got a job today and it paid like $500,000 a year, you're not gonna go out and take a loan and buy a house, right? Yeah. So, yeah. Buy a car, whatever.
Okay.
That's the idea. So when you convert illiquid assets to liquid assets, you have to liquidate bonds. And yeah, because the next in your portfolio, we assume again, there's a lot of assumptions here. We assume that households are well diversified and they have portfolio not only equities and bonds, and they could sell less liquid assets like equities or real estate. But when they convert illiquid to liquid, part of the liquidation will involve liquidating bonds.
Oh, okay.
Does that make sense?
Yeah.
So maybe in aggregate, there is some sale of bonds and therefore interest rates will affect. Make sense?
Makes sense. Thank you.
但是浮雕说的咱们老师也是浮雕的真惨。第二天上哪去？
来点没听过。
All right, everyone, let's finish up. So our next topic is short-term and long-term effects of monetary policy. So we looked at changes in Y, right? And we also looked at, oh, that's it. And so our next step is to look at changes in MS. All right. So monetary policy, as I said, is to keep things as simple as possible, how changes in a central bank's money supply and their balance sheet impacts R. And today we want to know how that change in R will have an impact on E, right? And we have two sets of equations. We can look at the analysis through the math, but we can also look at everything through the window of through graphs. So let's first look at how things work when we change money supply just within the money market. So we don't have to think too far into the UIP equation yet. So when we do monetary policy analysis, we have to split things into two parts because in reality, certain variables do not respond so quickly in the short run, right? So in the short term, we're going to make these assumptions. This is how we're going to define what short term means. Short term means that prices are sticky, meaning that they do not respond to changes in the money supply. So this is a fundamental concept in Keynesian economics. It's been adopted in all macro models, basically, in the field of economics. And this is basically saying that it's expensive to change prices constantly based on fluctuating expectations about what prices will be in the future, right? Money supplies will be in the future. And so prices don't move. Okay, they're insensitive to changes in money supply in the short term. And it's only in the short term where monetary policy has bite, okay, has a real impact. So the critics of Keynesian economics is obviously prices. If you assume that prices are fully flexible, then monetary policy doesn't matter, right? As you will see. In the long term, prices become flexible, meaning that R will be determined purely on real values, and as you'll see what that means, and therefore monetary policy has no real impact. And again, I'll show you what that means. So in other words, this is saying that R doesn't change. R doesn't change as change even if there's a change in MS. Why? Because prices also change. And you can see this, right? Because MS over P, if prices change in proportional to the change in MS, then nothing happens, right? And therefore R doesn't change, and therefore monetary policy is useless. So in modern times, I mean, in modern economics, we have incorporated this critique, right? Meaning that if we have enough time, yes, it's true. Monetary policy doesn't work. So let's go ahead and look at monetary policy change, namely increase in real money supply under sticky prices. So sticky prices just means hold P constant. And an increase in money supply means we are increasing, or just let me write delta MS is positive. So we should easily visualize what this looks like based on the graph we saw before the break. So I'm going to quickly label everything. And then I'm going to draw the money supply curve, MS over P. So if we have constant P and the numerator here increases, then this entire curve will shift which direction? If this is the origin and going away from the origin is positive, this curve will therefore shift away from the origin. So our real money supply curve will have this effect on the graph. Sorry, I use text here. MS, I'm going to write prime to indicate the change. And consequently, our equilibrium interest rate will shift from here to here. It's R naught and R prime. Okay, so just looking at the shift in lines in this plot, there's no economics explanation, but based on this graph, you can easily conclude that there is a new equilibrium interest rate, right? And it's lower. All right. Mathematics, we can look at the math. MS over P equal to LRY is our equilibrium money market equation. And we want this market clearing condition to hold at all times. And so if we have money supply increasing, you'll get an inequality. We have sticky prices. Let's hold everything constant. All else equal. The only other free parameter is R. R has to move in the direction that elevates L to restore parity. So R decreases, which is exactly what we see here. Intuition, economic intuition. What does an increase in real money supply means? It means they are printing money to buy something. To buy what? To buy bonds, right? That's usually what open market operations involves. You buy bonds. When you buy something, bond price increases. And we know there's a mechanical relationship between bond prices and bond yields. Bond yields decrease, which means on average, interest rates decreases. Right, because if bond prices elevate, the return, the fixed income return is less than before, and as a result, interest rates must be lower as well. Right, because it's more expensive to buy the bond now, right? So what happens when we have flexible prices instead of sticky prices? As I already said, nothing happens, right? So let me quickly do it again. We have R, L, R not. You don't have to do all this. You just have to know that this doesn't, what happens is, this is what happens. This is equal to delta MS over delta P, right? Whatever, okay, I don't put delta. Let's just put, let's say there's a scaling factor, alpha, right? The scaling factor P. P increased by some proportion, MS increasing by some proportion. If they're going to increase proportionally for sure on average, right? So the alpha goes away. So the real money supply curve doesn't change if there's flexible prices. And so monetary policy is ineffective, right? And so nothing happens. Make sense? So that's the idea. Long run, prices will respond to every other variable in the model, because we can't hold anything constant. That's how long run is defined. Nothing is constant anymore. So if MS increases, there's more dollars chasing same amount of goods, then prices must also reflect that. In the short run, we have sticky prices. Monetary policy has bite. Interest rates must move in a direction to offset this additional supply of liquidity, and it has to move downward in this case. So let me give you some more definitions here, just terminology. So the right and ability for central banks of every country to issue money, there's a specific term for that. It's called seigniorage. Okay, this is a powerful right because you can, as you can imagine, cash is just another form of debt, and when you print money to buy your own debt, it's as if you're giving yourself a loan, like a refinancing. So it's great to actually have this ability. And a lot of central banks have made a lot of money actually from doing this. Some may say like the bailout cost a lot of money. That's true. Taxpayers had to bail out the banks. True. But the central bank also bought a lot of financial assets at a fire sale discount. And how did they buy it? By printing money. With that money, they buy those mortgage-backed securities that are illiquid. Fine. They hold it out until the market recovered. They turn around and sell it for a profit. But they could only do that because they had the right to print money. Okay, that's what this is. So you want, if you're running a country, you want this right. Okay, you don't want to give this up. I explained the difference between monetary base and money supply already, so I'll leave you to read that. And this is, of course, again, I reiterate, open market operations is just one dimension of changing money supply. There are other dimensions here, but it's not an important mechanism in this class. Okay, so here I describe reserve ratios in which banks are required to have in order to curtail money multiplier. Okay. And the way it works is if I can lend out $1,000, that bank can just deposit that money at another bank. Bank can also issue $1,000, and they can do this infinity, right? That's another way to create money. Setting reserve ratios limits that infinite money creation. So if you look at mainland China, they do a lot of their central banking policy through managing reserve ratios. So the interesting part of today is to combine this money market equilibrium model, which is from your macroeconomic class. Hopefully you saw it before. It's actually what I just showed you is part of what's called ISLM. If you don't know that, that's fine. We're going to combine that model of money with the currency markets as represented by UIP, right? Because UIP is our asset pricing model. It has interest rates, and all we're doing is just combining money market equilibrium plus UIP. And to get a overall equilibrium conclusion, we just simply clear both markets, right? UIP holds, right? No more carry trade, positive expected value on carry trade. And also money supply equals money demand. Then we can find the fair value for each, right? And we're going to assume that UIP has to hold. Okay, so we're not going to say it's broken. We're not going to say the assumptions are wrong. We're just going to say it's always true. It's our asset pricing model right now. Okay, we will augment it with other risk factors later, but just for tractability and just understanding our working parts, this is what we're going to take. Okay, so how do you represent money supply equals money demand and UIP, which is R equals R star plus the height, right? We're going to combine this model through interest rates, okay? So this is my visual representation of two markets, and it's going to be linked with interest rates. Two y-axes, okay? They are positive in both directions, but they are different units, right? The y-axis above is exchange rate, so it's spot rate E, and the real money holding is L. So we know what this looks like, right? For the top graph, it's a downward sloping curve. And again, it is represented, every point on that curve represents an equilibrium such that interest rate differentials is wiped out by expected depreciation of the home currency, domestic currency, right? That's what UIP means on this graph. Every point on this line satisfies this equation. Now, the bottom graph, I'm going to rotate what we looked at before, or actually flip it this way, right? Invert it, mirror image. So this is still a downward sloping, but it's a mirror image is going to look like upward sloping, right? And we know how the liquidity preference curve achieves equilibrium. It has to intersect with the real money supply curve. And that will give me the equilibrium interest rate, which is this line here. And that intersection will give me this equilibrium spot rate. Yep. So this is the model we're working with. So if the math is a little bit unwieldy, just the simple algebra going through the head might be a little bit difficult, I guess, for some of you. This graph is just a shortcut to get to the point fast and then think about the economic intuition later, right? We can shift the money supply curve and think about where interest rates are and how that interest rates intersects with the UIP curve and how that ultimately give us a directional change in E, right? We can shift the L curve in a certain direction given changes in Y, right? And that can also lead to different interest rate outcomes, and that also intersects with the UIP at certain other places and also tells us the directional shift of E. And of course, we can always do other things with R star and E hat E. This is the model we're working with. And we typically call this the short run model because we usually assume that P is a constant, short run model. But of course, we can also represent a time dimension here, as I'll show you later. All right, so when working with this model, we can now do two types of analysis: temporary and permanent changes in certain policies. So today we're just working with monetary policy, and the way to distinct temporary from permanent is whether or not expectation has changed. So question mark here. And again, the example I give you is if we're thinking about long run forecasts, any short-term changes is not going to impact my future beliefs of what spot rate E will be if that change will be undone or canceled out sometime in the future. So if it's a temporary crisis that it restores itself eventually, then my long run forecast of exchange rates doesn't my beliefs about that doesn't matter, right? Doesn't change. Permanent changes, the example I give you is debt monetization. There has to be a permanent increase or decrease in money supply in which I have to, sorry, in this case, it's an increase in money supply to remove my debt from the public markets. That has to be true, right? I have to pay off the holders of my debt to be debt free. But in doing so, I have to print money and leave that money in the system permanently, right? That's definitely going to have an impact on expectations because forever, right? That's what expectations are. Even if my expectations are 5 years from now, this is going to change, right? Because that changes forever, right? Starting from now until infinity, right? So that's the kind of analysis we're going to do. All right, so as we did this already, right? Short-term, long-term, okay. Yeah, short-term, long-term, we already know. Sticky prices versus flexible prices. But now we're adding another layer, temporary versus permanent. Okay, so let's go ahead and do our first monetary policy analysis using the full model. So we have an increase in domestic money supply under sticky prices. So let us just represent this, this sentence or this phrase with symbols here. So sticky prices means prices are constant. So we don't have to think about prices moving. And also we have a change in money supply that's positive, right? So let's go ahead and analyze this with a starting point. So we have UIP, we have liquidity preference. Let's label everything. And UIP is represented by this curve, which is this simplified equation is sufficient. Okay. We have money market equilibrium at the intersection here, in which money supply equals liquidity demand. And as a result, we have a market clearing interest rate which sets our equilibrium spot rate today. But we have a change in money supply that's positive, which means that, like our previous slides, the money supply is going to shift away from the origin, right? Away from zero. So that's our new equilibrium because we have held P constant, right? That's only possible if we have sticky prices. And because things are temporary, right? There's no change. There's no change. Oops. There is no change in expectations, right? Because temporary means that it will be undone before we go into the long term, whatever that long term period is. All right, so the analysis continues. We have a shift in money supply. There's a new equilibrium. It's at this new intersection, which is a new interest rate that's lower. Let's call that R prime. And we notice that R prime is closer to the origin, which means that R prime must be smaller. And with a smaller interest rate, we have a higher intersection with UIP curve, which now tells us that our new spot rate is higher. All right, so that's the visual analysis, right? Without thinking too much about the math, without thinking about the intuition at all. So let's go through the math, right? So the math, we have MS over P equaling to L. We have sticky prices, but we have MS increasing, which means that the left-hand side is going to be greater than the right-hand side if we don't do anything, right? All else equal, we need to change the right-hand side so that we restore parity. That means L has to increase, and the only other free parameter in this model is R. So R has to decrease, right? This is just math. I'm again not thinking about the visual, just the math. This has to be true. We have a lower R, right? R prime, cool. So, but R prime means that this interest rate, the home interest rate, is now lower, right, than R star. So this is a plus, sorry. Then R star plus everything else, dot, dot, dot. What does that mean? That means that if expectations don't change, which means it's constant, then E has to move in a direction that reduces the right-hand side. And that's only possible if E increases, right? Because the larger denominator will decrease the entire expression, and that's what we get, right? Just the math, right? That's just the math. Okay, economics, which is the interesting part, right? So let's think through the logic here. Central banks decides to print a bunch of money. Print money. I'll just write CB for central bank. Central bank prints money and buys bonds, right? They buy bonds. That means bond prices increase, which means that bond yields decrease, which means that interest rates decrease. All right, so lower interest rates, or just let me just write the carry traders have positive expected returns. I do this by borrow R prime and lend R star, which requires converting domestic to foreign currency, right? So selling domestic increases E, right? Because if I sell domestic or buy foreign, right, then foreign currencies will get more expensive, and therefore E will increase. That's it, right? So our equilibrium fair price, stable price as a result has to be higher. That's the conclusion here. And the chain of logic is here, right? So now you have three ways to see it with the graphs without thinking too much to see where things go. You can look at the math equation itself to see how it maintains itself in order to find a new equilibrium, or you can just walk through the economics and get the same conclusions. All right. Pretty simple. So maybe you guys can take some time to do the next one. Now, the difference here, still temporary. So maybe I'll just write out the hints for you, right? Zero, still zero. Sticky prices, P is like constant. But now we have foreign money supply. So that is MS star, right? MS star has changed. It's increased, right? So I will give you a starting point. You guys take some time and you tell me what has to happen. So here's the starting point. Label the axis. And let me give you the equation, the equilibrium equations, right? Well, all right. So if MS star just means foreign central banks decides to change their money supply expansion, what does it mean for our graphs from the domestic central bank's viewpoint? So if you know the answer, just tell me what has to happen in this graph. So if you're confused, you can just draw the graph for the foreign central bank perspective, see what happens, and then get the same answer. Do that. But you probably have to invert the exchange rate, or you can just do one thing. Anybody? How about Joeying? I know Joeying's here today, so you have an answer? How about Liu Ling? You don't have to stand. Just you can just say you pass if you don't know. You don't know. Okay. All right, I'll try one more. How about Jiang Deyang? Yep. You pass or you don't know. Okay. You see this? Pretend this is the foreign central bank. Increase money supply. First thing that you should note is what? This, right? So there's a decrease in R, right? Well, in this model, where does that show up? Here, right? So what has to happen? We note that if R star is now lower, then this has to be true, right? R star prime plus dot, 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 dot. Then something has to happen here to restore parity. That's only possible if this term is larger, and that's possible if E goes down, right? So we must have E decreasing for any R. So for here, then this has to be here. But for any R, that has to be true, right? So the entire curve has to shift downward. Let me write R equals R star prime plus E hat E. Okay. That is this curve here, okay? So just visually seeing this, you should conclude that our spot exchange rate equilibrium must be lower, right? Which makes sense, right? If our trading partner decides to print tons of money, they effectively weaken their currency, and therefore our currency should be more valuable, right? That's the intuition. But of course, we can walk through. What happens, right? Economics is the following. Carry traders, right? Notice expected returns. They borrow foreign and lend domestic. And they have, in order to do that, they have to sell foreign and buy domestic. Therefore, E decreases, right? Of course, there is another step in the background, right? The background is, as the foreign central bank conducts open market operations, they print money and exchange that cash for debt, their own debt, and that pushes up the prices of their debt, and their interest rates declines, right? That's the extra step that I skipped, right? That's this logic here. But that only appears in this graph through R star, right? Comments, questions? So, I mean, I'll walk through it again. So this graph, I hope it's clear, right? We're taking the perspective of the domestic central bank. We want to know how interest rates change when we conduct monetary policy. So this is our real money market equilibrium model, just for us, from our perspective. So if we expand monetary policy, we conduct expansion of monetary policy under sticky prices. That means that if I print money to buy sovereign debt to affect domestic interest rates, there's going to be a downward pressure on interest rates because I'm bidding up the price of domestic bonds. With lower interest rates or lower returns on bonds, right, there's going to be a reaction from the financial markets. I mean, the FX markets. Carry traders will notice that with lower interest rates, the difference between domestic and foreign interest rates is larger, or there's a gap, right? In expectations, on average, there's a gap, and they want to exploit that positive expected returns by borrowing at lower interest rates and lending out at higher interest rates. And in order to take advantage of that, they have to convert, in this case, domestic to foreign. And that conversion will weaken the current domestic currency. Done. Okay, that's the logic of monetary policy on domestic. Right, the starting point is in this graph here, and that the end point is the foreign exchange markets from the perspective of the domestic country, right? This scenario here, there's something working in the background, right? You have foreign central banks doing the monetary policy. You could do the same analysis here, right? But rather than upward, it's downward, right? From the other side's perspective. And you can lead to the same conclusion. That's fine. But if you want to see things from your perspective, given your trading partner's actions, you can also do that. Just notice that that's going to show up through our stock, right? And that's going to look like a change in the UIP curve as a result, as opposed to, shifting the R, right? So in this case, from the perspective of the home country, if foreign central banks conducts expansionary monetary policy, interest rates going to decline. Again, the same logic. Carry traders come in, blah, blah, maximize or exploit positive expected returns, lend low, borrow high. Exchange rate is going to go in the direction that favors the country with a higher interest rate, relatively higher interest rate. Right. So two sides of the same analysis, right? Basically, two sides of the same analysis. When I do this analysis, my trading partner looks like this, right? When I do this, my trading partners look like this, vice versa. Okay, so everyone should know how to do this, right? And I've told you economics is I think it's very, very logical, linear. So things get a little bit complicated when we talk about permanent stuff. So let me just review temporary change money supply. Temporary means that the policy will be undone, reversed, before we get to the long-term analysis. So I don't tell you what that timeline looks like specifically. All I'm saying is that there's a division in which we analyze things in the short term and in a period of time in which we analyze things in the long term. The difference between short term and long term is determined based on how prices respond, right? If prices and also expectations, right? So if things change forever in the short term and persists in the long term, then something has to change in expectations. Okay, so exchange rate expectations do not change, right? As I highlight with temporary case, because they will be undone before we get to the long term. And this is the summary of what happened. So USD is the home currency, just to highlight to avoid confusion. So USD here is domestic. So the conclusion here is when there's an increase in money supply, there must be domestic depreciation. And if there's increase in foreign money supply, there must be domestic appreciation. So it's basically saying the same thing, right? Because the analysis is just the mirror image for the other country. Now, in the long term, as I said, temporary policies are reversed. And under flexible prices, interest rates don't change, right? Because MS over P, if P changes in proportions to MS, nothing, the real money supply curve doesn't change. So monetary policy is ineffective in the long run under flexible prices. Okay, so in the long term, in which we have permanent changes to E or E hat E, okay? There must be a change in expectations. And the key takeaway that you should have in mind is that E is just a price for another asset. And if prices overall are increasing, then E must also follow the same trend, right? So prices are rising, all asset prices are rising, everything's more expensive. And so E should also follow P. Okay, so in the long run, that's what you should see. So if P is constant in the short run, but the monetary policy is permanent, then you should expect inflation to some form. So E must transition to a higher level when there's a permanent change in expectations. So that's what I mean by E traces P. Because price levels, of course, will respond to the change in money supply. That has to happen, right? Because in the long term, there's going to be more dollars chasing the same amount of goods than before. So yes, there must be price movement as a result, but E, just like any other assets, must also follow the same trend. And okay, let's see. Okay, so maybe let's do a permanent scenario before I give you this explanation. Okay, so let's look at a permanent change in money supply. So let's go ahead and do the analysis first, and then I'll summarize. I'll backtrack a little bit. All right, so title: permanent increase in money supply under sticky prices. And then I'm going to transition from short run to long run. So permanent means here now, because it's an increase, that means delta E hat E is positive, right? If I believe that the central bank is going to, for example, monetize their debt permanently, they're going to remove their debt in the markets, then there's going to be a large sum of cash being injected into the system permanently. Overall, my expectations should change about the relative strength of my currency than before. Namely, it's going to be much weaker than before, right, relative to other currencies, just based on supply, differentials in supply of the currency. There's more of my currency than before than my trading partner's currency, all else equal. We have a domestic increase in money supply, so MS delta change is going to be also positive. And we're going to analyze this from sticky prices to flexible prices. So just P, okay? P will be allowed to respond to the change in MS, so that monetary policy is ineffective. Okay. So let's analyze this. Again, we have a starting point. Let's assume that we are in equilibrium. Let me label the axis. Tell you what this function is, this line is. It's this liquidity demand function. There is going to be a money market, money supply curve. And this point here is MS over P equaling to liquidity preference. There will be a market clearing interest rate, call that R, and that R will determine the spot exchange rate, the equilibrium spot exchange rate. Now let's analyze this in two parts because we have two things changing. We have this changing and we have this changing, right? So let's perhaps do the obvious. We know what this looks like. We know what a change in money supply looks like. It's a downward shift. This curve away from the origin. We know what happens to interest rates. It becomes lower. And all else equal, we're done, right? But we have this extra change here. So let's just work through it mathematically with equations, what exactly happens. So we have this term increasing, which means that this inequality is violated this way. To restore equilibrium, all else equal, if interest rates are unchanged, then we have to move E. That makes this expression lower, so it can only be higher, right? E has to move up so that the entire right-hand side decreases. So we must have a upward shift in the UIP curve today, right? Because expectations are beliefs, and therefore our beliefs must be incorporated in the markets immediately. And the UIP curve therefore must be shifted upwards. So this is R equals R star plus E hat E prime minus E over E. And therefore our spot rate actually is up here, right? So that is going to be E prime. Let's set that to E prime for now. Sorry, it's a bit crowded, but it's okay. We will move away from it. All right, so that's it, right? If we assume that prices are sticky, right? Because that's the fundamental assumption in which monetary policy has bite. So we've analyzed the permanent stuff in the short run. Now let's transition to the long run. The long run, we have prices being flexible, and now it will respond to the change in money supply, assuming no other changes in the money supply. In which case we have this curve moving back, right? So maybe before that analysis, let me highlight the short run conclusions. So our short run is here. So this is our short run, SR for short, okay? In the long run, prices responds to changes in money supply, obviously, right? The prices will catch up to the change in money supply and therefore eliminate the effectiveness of monetary policy. So we are back here, right? But something has persisted. Something has persisted today into the future. This has persisted, right? Expectations has changed. So UIP still remains elevated. And while our interest rates are back at here, our exchange rates, however, is here now. So I'm going to write E double prime. So we have moved from this point here and we've transitioned slowly over time as we move from short run to long run to here, right? So E double prime. So this point is our long run equilibrium. Cool. Now that's interesting and all, but why is this so fundamental? Well, just based on simple algebra and holding some variables constant, with some economic intuition, what I've actually showed you is a way to explain why there's so much volatility in FX markets. It's primarily because of monetary policy uncertainty and the fact that prices don't respond instantaneously. If you look at CPI prices over time, it doesn't move very much, right? It's very slow moving month to month, year to year. But FX rates moves a lot, right? And this model tells us there's a certain degree of overshooting, right? From E naught all the way to E prime, and then a reversion back to E double prime. So that's where volatility, well, that's exactly what volatility is, right? It's an overshoot and a reversion. And what I've demonstrated to you is with this simple model, it must occur, right? It must show up in the data. And you can verify yourself, right? Prices don't change very much month to month, year to year, relative to compared to the foreign exchange rates. It's wild fluctuations, month to month, year to year. Okay. All right, so ignoring this overshoot, the takeaway is the following, right? Going from E naught to E double prime makes sense because prices are rising, right? If prices are rising, as it does respond to the change in MS, we also should see a rise in E, right? As we go from E naught to E double prime. So that's what it means for E to trace P. We're kind of blacking out the short run analysis and just comparing our initial starting point E naught to the final destination, the long-term exchange rate E double prime. And the conclusion we have to draw is, yes, indeed, if prices have to catch up to the change in money supply, so does the spot exchange rate. And we can visually represent that in this graph here. Okay. So I use the word overshoot to characterize volatility. Okay. I'll show you that volatility plot, I think, next week. All right. So overshooting just means that you go beyond the trend and you revert back, right? So here we have a one-shot monetary policy expansion, right? So suppose our money supply curve is here. Money supply amount is at this level. So it's just a fixed number, right? A number that the central bank sets, but they decide to, for example, monetize their debt forever. In which case, money supply jumps to a higher level indefinitely, forever, right? In the long run, prices have to catch up to money supply, right? So what we should see is sticky prices for a while, but then slowly responding to the change in money supply, right? So let's just suppose that this is like the proper money supply proportional change, then it won't react immediately, right? That's what sticky prices mean. Eventually, in the long run, prices will catch up to the change in money supply. So there's a drift. So prices don't move in short run, but will catch up to the change in MS. All right. Under sticky prices, interest rates do have a change, right? Because of sticky prices, interest rates must drop, but its evolution is just like its prices. Eventually, monetary policy becomes ineffective. So the drop in interest rates, but a slow reversion back to the original interest rate level. Right? That's what you saw in this graph, right? We went from R to R prime and then back to R, right? So we have a reversion back to R. And finally, the overshooting, the volatility. So what we have, so I'm drawing a dashed line for the long run level. So what we have is we have an overshooting because of sticky prices beyond the long-term levels. And then we have a slow progression slow progression towards the long-term levels, right? So this is the overshooting. And this, from this point here to this point, is the tracing, right? The following. Okay, so let me say that all again. This slide is supposed to show you the timeline of how each of these variables evolve given a permanent monetary expansion. A permanent monetary expansion has two effects: a change in the money supply and a change in expectations. The example I've reiterated over and over again is, imagine a country wants to monetize their debt. That means print money to buy their debt. That means that they have to keep the money in the system indefinitely, right? So we can see that indefinite supply change in this left quadrant here. We started out with a money supply level and it jumps permanently forever, right? Because it's forever, obviously it's going to change expectations. In the long run, in this graph in the top right quadrant, prices don't respond immediately, right? Because we have sticky prices. But as we transition from short run to long run, prices will eventually catch up to that single shock, right? The single monetary policy action. That's when interest rates don't move, right? Monetary policy becomes ineffective, which is what we see here. We see interest rate move because of sticky prices, but if nothing else happens, right, interest rates must restore back to its original level because prices have moved. And because of this sticky prices and interest rate change, we see an overreaction, right? We see an overreaction in E in the short run. But as price levels erode that monetary policy effect, we will eventually revert to a lower level, but yet still elevated level, okay? Which makes sense, right? Because more money in the system means everything is more expensive, and that shouldn't exclude foreign assets as well, okay? And therefore, exchange rate traces prices. Okay. So the summary is here, right? Permanent changes have both short-term and long-term effects for permanent changes in money supply, all right? Long-term analysis, we always assume prices are flexible, in which case that change in price just means that price levels will catch up with the change in money supply, which eliminates any sort of monetary impact. But because we have a permanent change in money supply, expectations have to change, because expectations is about the future. If something is permanent, it affects all future values, right? Forever. And with this, right, with this change in expectations, we get an interesting feature. We get an overshooting and a reversion, which explains why there's so much volatility in the FX market. All right, so maybe I have the last 3 minutes to summarize. So let me go to the summary slides. Yes, so here is the, just if you want to not work through the economics yourself, this is just a cheat sheet, right? What happens when you do certain things. So if you want to increase money supply, what's the logic here? You buy bonds or sell bonds, you decrease interest rates or increase interest rates, and that has to change the incentive to save, etc. Okay, and we will talk about this more later, right? This fiscal policy channel, I believe next week, all right? Or maybe think about this. Maybe not next week, maybe after the midterm. But anyways, the fiscal policy channel, fiscal refers to government spending. Okay, and there's two ways to government spend. One is through taxes, tax cuts, I mean, and the other is through literally government spending, like building building infrastructure like highways and stuff, okay? That's gonna come through the Y. And we did analyze that case today, right? We saw that something has to change in the money market equilibrium when there's an increase in Y, liquidity preference has to change, and that impacts FX rates as a result. Okay, so I'll let you walk through this cheat sheet again yourself, since I only have 1 minute. And of course, the most important takeaway is exchange rate volatility, right? In the model we have 2 equations, right? Just 2 equations. And all we did was assume sticky prices and segmented our analysis into 2 parts. Long run, short run, and in the long run, we assume prices are flexible. With this setup, we've created a conclusion for ourselves that because of sticky prices, we must have an overshooting in the exchange rates followed by a reversion. And this is cool because it matches empirical data, which explains why, despite prices not moving so much month to month, volatility in FX markets can fluctuate wildly. And again, the intuition is that expectations about the future is changing all the time. And there's a lot of uncertainty about monetary policy. Okay, so that's all I have for you today. So next week is Chinese New Year, so we won't have class. And so obviously no quiz. So I'll see you guys in 2 weeks. So a reminder, there is a case study that's posted, right? So I hope everyone saw it. Let me see if I don't have the webpage over, but just check and make sure you know what the deadline is and submit by the deadline. Don't be late, okay? All right, see you guys and have a nice Chinese New Year.